economist, Morgan Stanley, to talk about exactly that. Chetan, hi, morning. Great to have you on the show. Chetan, so much happening on both the global as well as domestic front. But first, let's talk about things back home, because this likely overhaul of GST rates, 2 slabs going off, the maximum ones at that, coupled with the support from other measures that we've seen from the government, right, which is personal income tax cuts, rate cuts by the RBI. Where do you think all of this is headed into? And then what is your, estimated GDP projection?
So we think that this cumulative policy measures which the government has taken alongside, first we got the income tax cuts, and before that we had the capital expenditure growing well from the central government side and state government side. And then we got the RBI rate cuts, and now finally the GST cuts. So all of these measures in total would support domestic demand meaningfully. There is obviously some lag in all of these measures to come through to growth numbers. But we think that from the third quarter of this year, call it like towards September, October, you should see clear signs of domestic demand recovery. If you think of it, out of all the factors, the most important one, I think, was the RBI's policy rate cuts. Usually about in 3-4 months time after the policy rate cuts, it transmits to lending rates. And there's another 3-4 month lag from that point of time, which would imply that September, October would be the time when you should see meaningful support to growth coming in from that monetary policy with a lag. All these factors should support domestic demand recovery. However, we do have a slowdown in growth, but that's primarily because of the trade slowdown. It is likely that when trade slows, there will be some negative implications on the private investment side. Therefore, we are expecting growth to slow to around 6% by quarter ended December, and then begin to recover from first quarter of 2026, i.e. quarter ended March 2026. Because by that time, you would have seen more transmission of the policy easing that the government has taken up and the RBI has taken up. And at the same time, we think that by that time, you will also see some reduced negative effect from this global trade slowdown.
But Chetan, what's the inflationary impact of should the tariffs come by, and of course GST rationalization?
It's actually, for India, the challenge will be of lowflation. We've already seen that, core inflation is below 4%. And if you look at WPI, which is equal to PPI everywhere else in the world, that has also been quite weak. So, yeah, I think in some ways there will be reduced inflation. But this reduction in inflation because of GST should be seen more as a positive source of disinflation rather than something that should be seen as negative. So the deflationary pressure that we saw because of China's deflation and global trade slowdown, I think that is what we would call it as negative. But the one which we're going to see because of GST rate cuts should be seen as a positive support to the economy.
Does that leave the RBI then, Chetan? Are you anticipating further easing, or do you think they'll remain status quo for the remainder of the year?
We think RBI will cut again in October policy meeting, and we are also highlighting the risk that if the disinflationary pressures from rest of the world intensifies, then RBI will have scope to do one more rate cut in addition to the one that they will do in October.
Chetan, hi, morning. This is Nehi joining in the conversation. That's your expectation from the RBI and what our central bank back home is expected to do. But what about the Fed? Because there is so much pressure building in from Trump on the Fed chair in hopes of getting a rate cut. Do you think that could be possible in the September meeting?
So our house view is that there will not be a rate cut in September, but it is very much predicated on the next job sprint. We'll also see what Chair Powell mentions today in the Jackson Hole meeting, or event. Because if the chairman does indicate that the revision in jobs data point is a concern, it might sort of seal the expectation of a rate cut in September meeting. But it's possible that the chairman still indicates that unemployment rate is relatively low. And if you remember in the last press conference, um, chairman was very much focused on that number of unemployment rate. And that has not changed in the last sprint, despite the revision to the non-farm payrolls. So we'll see what Chair Powell decides to focus on. But currently, we think that August print will be very important for the Fed, whether they cut in September or not.
But Chetan, with respect to the bond markets, help us understand what sort of signals do you believe bond market is giving to the investors right now? Because for now, mixed movement is what we are seeing. Though the 10-year yields that are seen to be falling a little bit, while the 30-year yields, they are seen to be rising.
Yeah, I think the challenge for the bond market is that inflation at the starting point is still relatively high. And what is very different in this cycle is that the private sector balance sheets are in a very good shape. So if the Fed cuts interest rates, at the same time, you have private sector balance sheets which are in a good shape. So if private sector growth comes back, and remember that fiscal deficit is going to expand in 2026 because of the tax cuts that have been already announced. So a combination of strong demand from the government side, and at the same time, if the private demand picks up, that will be a concern for the bond market. So it will be interesting to see what the reaction of the bond market is as the Fed takes up its rate cuts. Our house view is that it comes alongside growth slowdown, i.e., private sector growth doesn't pick up immediately. And so our global macro strategy team is expecting the 10-year bond yield to go down to 4% by end of this year.
When Fed does cut rates, eventually, do you not see a flight of flows moving back into the US?
Well, generally that happens if Fed cuts in response to a recession type of risk. We don't see that in this cycle. We are expecting a slowdown in US growth. We're expecting it to slow to 1% year on year by the fourth quarter of this year from 2% that we saw the print in second quarter. But we're not expecting a recession. So our house view is that the dollar is going to still see further decline for two reasons. Number one is that there is the macro risk premium that the investors are attaching to the US current macro situation in terms of policy uncertainty, high fiscal deficit, rising public debt to GDP. And then the second reason is the fact that as the Fed cuts interest rates, the interest rate differentials between US and some of the trading partners, particularly the DM ones, will result into additional weakness in the dollar. So we're not expecting, at least as far as the flows are concerned, to weigh on the dollar. Dollar should not appreciate, and therefore, you should not be expecting a lot of capital inflows flowing back into the US.
That's the take on the dollar and some US macros. But Chetan, I want to shift your focus back to Asia. Since you track India and China both so closely, we've just had comments coming in yesterday from China saying that if the US is not willing to accept India's goods based on the high tariff, China's markets are open for India's goods. Help us understand how this would shape up macros for both of these nations in terms of their export and import figures.
Well, as far as the trade is concerned, I think there is definitely a lot more scope for India and China to have more trade. The challenge, though, is I think for India as to what to export to China, because almost everything that India is able to export to the US, so is China. Either China is also able to export that to the rest of the world. So there is that sort of like a need to figure out a market in China for Indian products, which is something that China can import from India. I think the other way around, i.e., India's needs to import products from China. That is a huge one, particularly as you know that India is trying to get more into manufacturing. It needs a lot of capital equipments. Also, that some of the components that India wants to now make, like iPhones, you need that to come from China. So I think the India-China trade relationship is imbalanced, and what we need to still see is the evidence of what are the products that India can export to China more.
Interesting. Chetan, great having you on the show today. Thanks for your insights.